The US government can steal from you in ways that make them popular. Artificially low interest rates, that is the Fed manipulating interest rates down, penalizes savers and benefits spenders and investors like myself. The Fed, through inflation, can devalue the nominal consideration that one receives for Social Security, Medicare, Medicaid, things like that. To the extent that they foster inflation, to the extent that they manipulate interest rates lower, they're popular. They don't need to steal your gold. They don't need to steal your IRA. Increases in tax, allegedly on the rich, are inevitably popular. It's theft. So I don't think that the government needs to steal from you overtly, because stealing from you overtly constitutes risk. You could vote them out of office, or remember, there's probably 400 million guns in private circulation in the United States. That's a real risk. There's a bunch of folks out there who know how to use them. You push them too far, things get real ugly. But if they steal from you for imposing idiotic regulations, or changing taxes, or promulgating inflation, or artificially low interest rates, all those are theft. All those are confiscation, but that form of confiscation makes them popular. Well, pretty clearly the easy money's been made. You know, a basket of juniors purchased the first time that you and I talked about uranium in 2022, probably up 400% or 500%. I mean, stupid numbers. I've taken my money off the table. I haven't sold all my uranium juniors, but I sold enough that I have no net investment in them, including selling enough to pay the capital gains tax. I think the big money is ahead. Well, not the big money. I think the sure money is ahead of us, because the emergence of a term contract in uranium means that uranium producers can lock in prices and quantities with investment grade counterparties for as much as 15 years. You can't do that in any other commodity. And as that certainty around revenue, and less so around margin, materializes, the debt cost of capital to uranium builders that have a price locked in for 15 years is going to be 300 or 400 basis points lower than any other commodity. This is stupid. Two, lazy old securities analysts like myself, when you look at a development stage project over 15 or 20 years, you're trying to do a net present value, and your price calculations are all guesses. In every other commodity market on the planet, except for uranium, their equity cost of capital is going to be less. It's going to take 2 or 3 years to work its way through, because right now those term contracts are opaque. The companies, for competitive reasons, aren't disclosing them. The companies that do disclose them will have lower costs of capital, which means 5 years from now, while there might not be a uniform reporting requirement for those contracts, there will be voluntary reporting, because the companies that accurately and voluntarily report will have higher share prices than those that don't. So while the big money has been made, the sure money is ahead of us. You know, we have a circumstance now where developers, the next gens of the world, the Fissions of the world, the Boss Energies of the world, the Deep Yellows of the world, people who wouldn't have been able to build mines on their own account 10 years ago, because they didn't have access to on-balance sheet investment grade credit, will be able to do it. If you have a turnkey contract to build your project, even if you pay a bit too much for the insurance of a turnkey contract, while at the same time you've locked in the price and terms for a substantial amount of your production with an investment grade counterparty, a Tokyo Electric Power, a China General Nuclear, a Duke Power, a Southern Company, you can literally take that to the bank. Companies that didn't have a prayer of building projects will be able to build projects. And the fact that they can build them means that they'll be more powerful in the merger and acquisition market, where they say to an acquirer, if you pay up, we'll sell. If you don't, we'll build. And the will build threat has credibility now. As you know, I'm in front of the FDIC right now, starting a new bank. And they have said, without saying it, your application is going a little slow because we have other concerns. Looking backwards, Silicon Valley Bank, Sovereign Bank, First Republic Bank, all these kinds of things. There's enough confidence in the system right now, Tom, that we aren't at a crisis point. Americans still believe in too big to fail. They still believe that perhaps what they do is they shift their deposits from community banks that pay them interest to great big banks that don't pay them interest for safety. And when I explain in lectures the fact that the U.S. banking system has too many long-term denominated assets, 7 or 8 year assets, funded by overnight liabilities, this mismatch of duration is what brought down the savings and loan industry. I mean, it's a real problem, and it's a problem that's there today. I think probably we get through this. I think that you will see some smaller banks that succumb to commercial real estate lending portfolios and this mismatch. Make no mistake, if you own 8 or 10 year long assets that you put in place in 2002, 2003 at half of today's interest rates, the FDIC isn't requiring you to mark those to market if you say they're held to maturity. But the truth is that what you pay for capital in the overnight accounts has doubled, while the net present value of your free cash flows as a consequence of today's higher interest rates is off by 20 or 30%. There are a bunch of banks in the US that are zombies. A lot of them get through unless, in addition to having this time mismatch, they have large commercial real estate portfolios, in which case they're toast. Yeah, we aren't seeing the markdowns in residential that we're seeing in commercial. I mean, I've seen, fairly recently, hotels as an example that changed hands 4 years ago at $600 or $700 million, crossing off at 125. If the guy who bought that hotel had financed that $600 million purchase with $400 million in debt, the lender's been marked down 70%. The equity holder went to equity heaven. He's gone. And you are seeing about a year ago, I was in Midtown Manhattan, and I was in a second tier, Class B office building. And the office building was 12% occupied. They can't service the running expenses of the building, never mind the debt, with 12% occupancy. The lender is going to get that building back. And then the lender, in addition to having a non-performing loan, is going to have operating losses on his or her collateral. We haven't worked that through the system yet. Now, this isn't a circumstance that's going to bring down the United States. But it could easily be the circumstance that precipitates a 2008-style liquidity crunch. Doug Casey famously points out that a foreclosure doesn't destroy real wealth. The building goes away. The building doesn't go away. It just changes hands. It goes from dumb money to smart money. And nothing in the world pisses dumb money off than losing to smart money. Ask the bank for the statement of financial condition. The FDIC requires that the bank give you a statement of financial condition. If they're public, get the proxy statement, get the balance sheet, get the income statement. I mean, first of all, banks are supposed to have money, right? The Fed suggests that a 7% equity slice is well capitalized, which means that 7% of total capital needs to be equity. I'm an old guy. I prefer 10. More money is better than less money. They are forced to explain to you the median maturity that they have on their asset class and whether or not they mark to market. It's good to understand that. But, Tom, right now, there is well over $1 trillion in deposits held by Americans in American banks that pays no interest, which is to say, separate and apart from the big picture risk There's a bunch of folks out there who have entrusted money to banks that pay them no interest whatsoever. The biggest risk that those depositors face is to the left of their right ear and to the right of their left ear. You can either get paid 2 or 4.3, or you can get paid nothing. If you're dumb enough to take nothing, the banks are going to give you that, nothing. People don't do the work. You don't protect or save. Liquidity is something that you have to have, but you have to understand it's a cost. People who look conventionally at the world today, Tom, believe that inflation is registered in the consumer price index, which is wrong. The consumer price index, first of all, is hedonistically adjusted. Second of all, when it's inconvenient, doesn't include food or fuel, which is problematic for people who eat. But most importantly, it doesn't include tax. I believe that the basket of goods and services I consume means that the purchasing power of my savings is declining at 7 or 7.5, maybe 8% a year. While I have substantial, and I'm making sort of 4.3, 4.4% on that liquidity, so I'm really losing 3% a year. I regard the loss in purchasing power as an option payment, because having the liquidity will allow me to take advantage of a liquidity shortage, a 2008 style event, rather than being taken advantage of, by it. I don't regard my savings as a store of value. I regard them as a necessary cost. I also personally regard my bullion as cash. Yeah, there's a lot of people for whom I don't think their bullion should be regarded by them as cash, because they refuse to sell it. For them, it's a different asset class. For me, it's some of both. It's insurance, but I do know that there have been circumstances where other asset classes came to me to represent better value, where I sold some bullion and bought them. So for me, my goal is non-correlated cash, volatile cash, but good cash nonetheless.